Those states represent a yearly market of 420 petajoules, PJ, equivalent to 7.8 million tons of LNG worth about $3 billion. That represents just 2% of global LNG trade, but import proponents say the terminals would be another key outlet for spot cargoes of the fuel, especially during periods of low demand in the Northern Hemisphere. Piping gas from Queensland in Northern Australia to southern markets is expensive, making LNG imports potentially viable. Credit Suisse analyst Saul Kavanagh says, though, if final investment decisions are delayed into 2020, the case for imports will weaken as pipeline tariff reforms are likely by then. Eastern Australia has ample gas reserves to meet demand. The market outlook is tight, though, due to falling output from ExxonMobil's and BHP Group's Gippsland Basin joint venture off Victoria, rising production costs and state restrictions on onshore drilling. We definitely would see a rationale for one terminal to give another source of gas into the East Coast market, said Nicholas Brown, Asia Gas and LNG Director at consultancy Wood Mackenzie. We think one terminal would be sufficient till the mid to late 2020s. AGL's Crib Point project is the most likely to go ahead, industry executives and analysts say. Australian Industrial Energies, AIE, Port Kembla terminal is also possible, but that hinges on signing up industrial customers. Newcastle LNG and Venice Energy are looking to limit commercial risk by building import terminals and charging suppliers and traders to regasifi LNG to sell to customers. We aim to provide a cost-efficient infrastructure solution in markets that are in need of gas, said EPIK founder Ziyun. We would take those cargoes out of our portfolio, and we would decide where they come from, Woodside Chief Executive Peter Coleman told reporters in February. ExxonMobil is a big wild card, as it is considering imports to protect its turf in southeastern Australia, where it has been the dominant supplier for nearly 50 years. Its infrastructure and experience selling into the southeastern market put it in a unique position, said ExxonMobil Australia Chairman Richard Owen. We've got some competitive advantage and probably have a little bit more time than some of the other players, Owen said at a business event on Friday. Advantage to AGL importing LNG into a gas-rich country is not new. Both Malaysia and Indonesia, the third and fifth biggest LNG producers, have import terminals because transporting gas between islands by ship makes more sense than pipelines. AGL, Australia's number 2 energy retailer, is the furthest ahead with its import plan. Pending a state environmental review, it expects to make a final investment decision by early 2020, targeting first imports in 2021. Its advantage over AIE is that it has an existing customer base for its gas. We think there's a significant shortfall of gas in the domestic market, said AIE Chief Executive James Balderstone. We've had oil prices moving around a fair bit and a lot of our LNG is priced to oil. That's obviously a big issue, Balderstone said. At $60 a barrel for oil, several dollars below the current Brent price, AIE sees LNG imports as competitive with domestic pipeline gas. O/R Royal Dutch Shell's and PetroChina's Aero Energy Surat project in Queensland, Australia's biggest undeveloped coal seam gas resource, aims to start producing by 2021, but has been delayed due to a spat between the partners. An international LNG trader said Australia could build up to 2 LNG import terminals, but called it absurd. The country just needs to lower pipeline tariffs to ease the flow of gas from north to south, he said.